Him's House, episode 12. We are here after Q3 earnings. They were last night. Today is election day, but more importantly, it is the day after Q3 earnings. I'm Jonathan Stern. I'm here with Lewis Stevens and Dr. H. I want to go through a couple key metrics from the call last night, and then I'll turn it over to Lewis and Dr. H. For the first time ever, subscribers eclipsed 2 million. They announced hers is at 400,000 subscribers, so 20% of the total base. Revenue came in at 401 million versus an estimate of 382 million. The closest on the whole internet, the closest entity to the actual number was Him's House. Far closer than analysts, far closer than company guidance. Earnings was 35 cents against 5 cents estimated. Now, there was a tax allowance that sort of distorted that number. We might get into that. Record free cash flow, 79 million. The company raised Q4 and full year revenue guidance. And for the first time ever, share of total subscribers using a personalized solution is now above 50%. Again, first time in company history. It was at 42% in Q2. So that's a massive move higher. How are we feeling? Lewis.
I feel great.
Dr. H, how are we feeling?
From a medical standpoint, I feel great about this. I love the percentage of people on personalized solutions now being in the slight majority of it now. It really goes along with the mission of HIMSS, as what Andrew Dudum has mentioned many times. They want to bring forth accessible, personalized solutions, and they're just showing it right now. So that one really stood out to me.
So, Johnny, did we post the live stream?
It's up.
Okay, so the live stream, I talked a lot about earnings, and specifically I highlighted the handful of metrics that really illustrate that this was HIMSS' best quarter in its company history. And I would say that is to some degree by virtue of it just naturally making progress. I think it really started reporting its best quarters ever, the really strong quarters where it generated free cash flow, its margins expanded, its growth either accelerated or sustained at higher levels. It continued to introduce unique products that increased retention. Those quote unquote best quarters ever really started in late 2023, but the company has sustained improving upon those already phenomenal quarters since late 2023. And, the principal metrics that illustrate that idea are its margins and its rate of growth and its ability to acquire customers at reasonable prices, such that the present value of the cash flows associated with those customers are very much positive and still very much attractive to us, the shareholders of the business. So I thought it was a phenomenal report. I do just want to say that there was one analyst that accurately called the total revenue, with that total revenue being above 400, and I was that analyst, and we were the team that brought that perspective to the world.
I said Him's House nailed it, Lewis. Him's House was the closest. Are you saying you as a separate thing from Him's House, Lewis?
No, I just wanted to be clear that we as a team noted that revenue could and likely would come in over 400 million. And that really, where did my perspective come from? And yeah, I'm joking a little bit. I don't take the fact that I singularly. I'm kidding. I did share that perspective on this podcast, but where did my perspective come from? My perspective comes from my interaction, my routine, weekly, sometimes daily interaction with Dr. H and the rest of the HIMSS community. Without that perspective, without the notion that this GLP-1 technology is being adopted at an incredibly rapid rate out there in the field, I wouldn't have had the perspective that I had. So yes, I think I don't know. Maybe someone else said above 400 million, but I know I said that, and that is, I could only say that with the help of the HIMSS community.
So it was a stellar report pretty much all around. Is there anything you're concerned about? either of you? Any like yellow flags or red flags that we should talk about before double clicking into the good stuff?
Dr. H, do you have any concerns that come to mind?
Not really concerns, but some people were really excited and saying, hey, in 2025, they announced they're going to have Liraglutide available. That's awesome. Yeah, that's the generic version of Victoza, which is going to be available. And then in the medical channel on the Discord, we were chatting about that medicine, and myself and the other doc in that channel were talking about the nature of that medicine and how, I like how Hims and the team, they have a plan set for when this FDA shortage thing takes place, and the other medicines come off the shortage list, and it demonstrates they have a backup plan, and they're looking forward a couple of steps. And
Dr. H, I don't know that we've talked about liraglutide on the podcast yet. Maybe it was floated once or twice, but could you give us just a brief overview of that type of GLP-1 and then how it compares to semaglutide and tirzepatide?
Yeah. And this is what we kind of talked about in the channel. It is a GLP-1 brand name Victoza, generically available and used for diabetes and weight management. It is not as effective for weight management and weight loss compared to semaglutide and tirzepatide. You're looking at maybe 5-ish% mean average weight loss at a year versus anywhere from 10 to 15% for the other medicines. So it is noticeably a little bit less effective. Side effect profile, same side effects, but some people just don't tolerate it as well. And this medicine is taken every single day rather than once a week. So on the channel, we're talking about, okay, great, they have a plan. You're very forward thinking, but however, we're debating about how compliant and how effective this would be for patients who are going to be able to use it as intended. Can someone keep up with the daily injections? Can they keep the side effects at bay? And I'm thinking, along with the other doc, that, he's seen in his own practice, the side effects of this medicine. It's a very viable medicine that people would naturally be interested in when the shortage comes off for the other medicines. People are going to be interested in getting their hands on accessible, more affordable medicines. They may be inclined to try the medicine and see if it works for them. There's a very decent to high chance that it may not work well for them. And what's nice about the Hims plan is it's almost like a way to bring in patients and market. They can say, hey, it's really crummy that these other medicines aren't available due to the FDA decision and the brand name stuff, but we have this available. Come try it out. If it doesn't work, I honestly think that they can capture that patient percentage and switch them over to the oral medicines. And the oral medicines that Hims has available, the effectiveness rate is, I think it's going to be close to what you can get with the generic Victoza, 5%, maybe even slightly above 5%. And that also is a daily medicine, but it's not an injection. So you'll have this big cohort of people who all of a sudden can't access semaglutide, tirzepatide. They want to try the other one that's available. If it works great for them, awesome. If it doesn't, they're in that ecosystem now with Hims, and they have these other options available that are actually pretty effective. So by itself, having this other GLP available next year is exciting. And as I mentioned, it shows they're planning ahead, but the actual medicine itself is not as exciting to me as how they can use that availability of this medicines to bring people into the Hims ecosystem.
I want to talk about personalized medicines. We have this chart from the shareholder letter where, again, for the first time in company history, more than 50% of the customer base is using personalized products. We don't yet know exactly what the company's going to do when semaglutide comes off shortage, when tirzepatide officially comes off shortage. There's been some speculation, and Dudum alluded to it last night, that the rough plan is to continue to offer these drugs on a personalized basis. How large is that opportunity, say, for GLP-1s or other drugs? And do we expect, I guess, where do we expect this personalized curve, which is now above 50% to go in the coming quarters? Like, could we hit 75%, 80%?
I feel like
from a financial perspective, I would just say that the importance of the personalized medication trend, subscribing medicine that is personalized to the individual and the individual's characteristics and the characteristics of their condition. This is important because it creates cash flow stickiness. And on the live stream last night, which I do recommend those listening ultimately listen to, but the value of any stock, the value of any business is the present value of the cash flows it will produce. And maybe for some of you listening, that phrase, the present value of cash flows, might be a little unapproachable, but ultimately the value of a business is the money that it generates for us. So if we can create a product that is stickier because it's personalized to the individual characteristics of a given patient, that means there's going to be more cash around for us as shareholders over the long run. And that is ultimately what buttresses the value of any stock, the amount of cash that it can generate. And we discussed it at length on the live stream yesterday, so I would encourage you to check that out. As it relates to the clinical aspect of it, I'm interested to hear your thoughts, Dr. H, on the personalized medication trend and that becoming a larger portion of HIM's overall book of business. What's your take in terms of the effectiveness, the value to the business, the value to patients? How do you see this growing trend of personalized medication?
I think that HIMS is going to really push to increase the percentage of people on personalized medicines. And I think one big thing of it will be that they're really trying to build this whole deep treasure trove of data to protect themselves from competitors or regulations or lawsuits. You know, everyone's worried about the GLPs. What happens when the Novo is going to come after them or Lilly and they're saying, your medicine's not safe? You know, what's going on? You know, we really should try to curb the usage of these compounds. Well, when HIMS is directing and having this many number of people on these treatments, they can then defend and say, hey, look at this. We have X amount of people who are on the personalized dosages. These are the reported side effect numbers. It compares very favorably to the brand name dosages. And we saw that even preemptively before the earnings report came out. You know, the HIMS white paper came out and they're already mentioning these side effect numbers. There's a little bit of drama with, you know, on Twitter of people saying, oh, they shouldn't have directly compared themselves to the brand names and said this and that. But I think they're building a defense to really allow themselves to, you know, continue doing what they're doing when all these people are going to come, you know, knocking on the doors and saying, you got to stop doing this. So I think more so from not just a clinical standpoint where you have personalized dosages and things like that, but they're really preparing themselves for maybe a legal battle as well.
I want to read something that Yemi Okupe, the CFO, said last night. He said, the focus of our strategy is centered around acquiring, retaining, and expanding our relationships with our subscribers. As a result, we'll no longer report on orders and average order value after our 2024 10K filing. So we have one more report with average order value, and then it's going away. Thoughts on why they're doing this? It has been a number reported since the company went public. So this is an interesting shift, if nothing else.
So my response, we can talk about it, but I would just like to give listeners some context for the meaning of companies withdrawing information or creating narratives using the data that they have available to them. So I think the initial reaction, and in fact, I think the share price sold off on that news, but the initial reaction for anybody is, okay, if they're going to provide less data, that's bearish. Because if the numbers were good, or if the numbers were favorable, or if they reflected what the managers and the board and the C-suite want them to reflect, then they would continue to share that information. But frankly, it's just not the case. And good examples are Apple in 2017 to 2019, around that period, they stopped sharing iPhone volumes. And if you watch CNBC during that time, everybody was very bearish. There were notable pundits on CNBC at that time in the media saying, well, they stopped reporting iPhone volumes. This means that competition is encroaching on their market share globally. And this is bearish because if things were going well, if they were selling more iPhones year over year, then they would continue to report this information. And ultimately, it was just a misguided perspective because Apple is up from that period something like 500%, some incredible amount. I think it might be, it's roughly about 500%, including dividends from that period of 2017 to 2019. And Microsoft has altered the way that it reports data. CrowdStrike recently stopped reporting its net retention rate, irrespective of the issues that it had. And ultimately, CrowdStrike has fired on all cylinders other than that one outlier event that it faced that was totally unrelated to it withdrawing its net retention rate earlier in the year. So the withdrawal of information is not in and of itself a bearish element to a thesis.
Regarding average order value specifically, though, any comment about that and why they removed it?
I do not have a specific perspective on that. From what I can understand, and I haven't fully delved into that, but from what I can understand, the removal of average order value is just related to the fluctuating composition of products that they have or product composition on the platform. And they determine that average order value is just not valuable to conveying the HIMSS narrative as it is today. And I think GLP-1s have somehow impacted that in the sense that the value of GLP-1s, they have spiked the average order value. And there's a fairly high likelihood that their ability to sell GLP-1s at the volume at which they're currently selling them could become impaired as a result of the shortages ending, which would result in the average order value declining in subsequent quarters and just generally being very volatile with the advent of this new set of products and compounded GLP-1s, personalized GLP-1s. So I didn't really focus on that too much. The North Star metrics, we've shared them many times now, and the North Star metrics have all been extraordinarily healthy. The reason for average order value the disclosure being removed is likely has to do with just the evolving product set and the volatility in average order value that results from the evolving product set.
Great. Good segue into the North Star metrics. Any update there, Louis? Any update on those North Star metrics?
Yeah, everything was great. We, on the live stream, which if you didn't, I think.
And I guess to start, could you, for those who are just joining us, what are the North Star metrics? And then maybe let's get into the update.
Sure. So the North Star metrics are CAC to per net new sub, which came in right in line with where it's been for the last 6 or so quarters. And in addition to that, the principal North Star metrics are the difference between gross profit margin and sales and marketing as a percentage of revenue, as well as just the nominal difference between gross profit and sales and marketing. And in Q3 2024, sales and marketing as a percentage of revenue hit its lowest point in the company's history, ex-COVID, which, where there was artificial demand related to lockdowns, and some of the early years. We just don't have great data for, late 17, 18, 19. But so sales and marketing as a percentage of revenue hit its lowest level effectively ever. Meanwhile, growth accelerated. And I think it should be noted that GLP-1s, from my math, only contributed to a 10% boost in total subscriber growth. So they had 40% growth in subscribers from the core non-GLP-1 business. And that was boosted by 10%, 1.1 times 40 equals 44%. That's the math I have. So only 10% of the growth boost came from GLP-1s from a subscriber perspective. But remember what we just talked about in terms of average order value. The GLP-1s are bringing a higher SKU price, average selling price. It's a more expensive SKU, more valuable SKU, ultimately, stock keeping unit, a product in the inventory of HIMSS. And so we've gotten a huge revenue boost from a more lucrative SKU, but ultimately subscriber growth was very healthy without GLP-1s, and that should be noted. And I think coming back to one of your original questions, Johnny, what should we be bearish about? What should we be concerned about? And the concern is that, the central bear thesis, and we've talked about it often on this podcast, the central bear thesis is that CAC per net new sub, so marketing expense, sales and marketing, which was 182 million point something in Q3 2024, divided by total number of customers acquired, which I believe was about 200K in Q3 2024, equals this CAC to net new sub, which is ultimately a discounted cash flow model. It is ultimately an initial outlay of capital from which future cash flows are generated. And that is the basis of the value of a stock. That's the basis of the value of any project. There's an initial outlay of capital. In this case, it's $182 million, Q3 2024 sales and marketing, from which we have cash flows that are generated in the form of the average gross profit that we generate per subscriber of those 200,000 or so over the course of 12, 36, 60, 120 months. And so all of this math that I'm describing came in very healthy. It was exactly where we wanted it to be. Growth continued at an elevated rate. Subscriber growth was healthy, ex GLP-1s. And then the last thing I'll say, and I got a little bit off topic there in trying to conclude this. You asked what should we be concerned about? And the concern is growth without GLP-1s. I personally have never had this concern, but if everyone's wondering what the main concern is for the market, it's what does growth without GLP-1s look like? And we have a great answer. GLP-1s only boosted growth by 10% in terms of net new subscribers. And so the core business is very healthy. And then the other thing that I would add, and then I'm going to wrap up here, is that weight loss is contributing meaningfully to the business, ex GLP-1s.
Right.
And HIMSS is a multi-product platform, and weight loss is just the latest product to meaningfully contribute to this growth trajectory. And there will be new products in addition to a holistic weight loss offering that will continue to contribute. Both the new products and the existing ex GLP-1 weight loss product will continue to buttress this 40% subscriber growth and buttress this, what will ultimately be something like 100% growth in Q4 2024. Current guidance is for 90% growth.
Which is massive. I want to ask about weight loss because in the second quarter, they revealed that the run rate on that business or vertical or product had reached 100 million, which is the fastest growing in company history. Was there any update there on where it is now? That is weight loss ex GLP-1.
I personally did not hear an
I
update.
didn't hear anything. Maybe we can look, but yeah, I don't know if there was an update there or not.
It was our first night doing the live stream, and the live stream, we were juggling a few things at a time.
Yeah, well, as I said, I had two chats going, the chat in YouTube and the chat in Discord. I was trying to converse with you, Lewis. I was trying to make sense of this earnings report and listen to Andrew Dudum and Yemi and everyone else. It was a little overwhelming, actually. I'm excited for Q4, but it was the first time I'd done something like that.
Yeah, what I would say is we came in very prepared. We know our North Star metrics. We've been working on this thesis for a long time, and we came in prepared, and we got exactly what we wanted. There's, I would say there's a lot. The one thing that really stood out to me was CFO Yemi Okupe noting that more and more subscribers are becoming multi-condition subscribers. And that is a part of this concept of CAC to net new sub, right? There is a concern that CAC to net new sub grows to 1,500 or 2,000 when it's been at an average of about 750 to 1,000 over the last 6 to 8 quarters, roughly.
Yeah.
But if they can become an even more compelling multi-product platform such that a customer shows up on the platform day one, buys a hair loss treatment, buys a dermatology treatment, and then over time finds that they get utility out of adjacent products, then maybe $1,500 per new subscriber is actually cheap because that subscriber ends up buying 3 or 4 different products over the course of 5 to 10 years, 2 of which it become daily habit products. So hearing from Yumeo Coupe that more and more subscribers were becoming multi-conditioned buttresses the overall thesis, with that thesis being that Hims is a multi-product platform that can expand the cash flows that each subscriber produces by launching new compelling products and upselling each of those subscribers, or many of them, on those new compelling products, thereby increasing the value of those subscribers over time and ultimately increasing the value of the business. And this is really at the heart of the Hims and Hers Health thesis, this multi-product orientation.
I want to close with a couple more financial topics. We can make these rapid fire. I don't know that we need to dwell on these. Number one, share buybacks. Hims used $30 million to repurchase close to 2 million shares at an average price of $15.83. Are we heartened by the company continuing to double down at these prices? As we record this, it's above $20 a share. Company is buying just under 16. What do we think about that?
So I gave a lengthy discussion on the live stream last night. I would encourage everybody to go check out that live stream. It was a lot of fun, and we definitely talked a lot about the thesis. But my personal opinion is that I'm not really excited about the buybacks. And I felt this way about, for instance, Snowflake. I wish they would just stack the cash and then deploy it into a value accretive acquisition at some point. But, what was my point last night? My point was that their capital allocation has been so brilliant in the face of unending, relentless doubt from Wall Street and big investors. Their capital allocation has been phenomenal in the way that they've structured the income statement, how much they allocate to cost of goods sold, how much they allocate to sales and marketing, how much they allocate to the administrative component of the business, which is huge, right? Grab is in the gutter. It's the Uber of Southeast Asia. Why? Because they overinvested in general and administration and administrative. They didn't allocate capital very well, right? And so just witnessing how well and how disciplined they've been in the structuring of the income statement in terms of how they've allocated capital across it has been incredibly heartening. So for Lewis to say, I didn't like that they accelerated the growth of free cash flow per share, which is the basis of all stock value, via buybacks, who am I to say, right? They're doing a phenomenal job. And I continue to be incredibly impressed by the method of capital allocation, the competence with which they've been allocating capital. And so let's grow free cash flow per share with some buybacks. Let's do it.
Next topic is stock-based compensation. It came in around 25 million. What does that mean for the listeners, particularly those who are less familiar with academic finance or that metric? How are we to think about that?
So ultimately, stock-based compensation, the good in it is that it arguably most effectively incentivizes employees to grow the company. It structures their incentives such that they have a long-term time horizon, such that they see in a very concrete way the fruits of their labor. If they show up, if they work very hard for the corporation and the corporation stock appreciates, they have ownership in it, the incentives are aligned very well. That being said, if you're on social media, you will never see that. You'll never see that description. If you're on social media, there's only one description of stock-based compensation, and that is that the management is using it as their own little piggy bank, diluting shareholders, running away with our profits, and they're being frivolous with the money and overcompensating employees and ultimately not structuring incentives in a good way. And so, that's the one you'll hear. And at the end of the day, what can we do to assess the impacts of stock-based compensation? And what we can do, very simply, is to monitor free cash flow per share, right? People get so wrapped around the axle of, okay, the GAAP accounting measure of stock-based compensation is X percentage of revenue. And really, what does that mean? It doesn't mean anything. All that matters is after the end of 4 periods, where has free cash flow per share gotten? Is it up? Is it down? Is it in the middle? That is the true measure of the effectiveness of capital allocation by the C-suite, by specifically Andrew Dudeman and Yumio Coupe. And so, coming back to my former point related to buybacks, it's like, are buybacks the right way to allocate capital? Ultimately, they're buying back shares. That's an allocation of capital. What's the ROI on that? Is stock-based compensation the right way to allocate capital? Ultimately, that's an allocation of shareholder capital into labor to drive the growth of the business. So is that the right decision or not? And again, people get so wrapped around the axle that it can be very nebulous. It can be difficult to ascertain exactly what the ROI on a buyback is at $15 a share versus, issuing stock-based compensation at $20 a share. And so the true north is the growth or decline or stagnation of free cash flow per share. And looking at Hims and Hers Health's free cash flow per share, which is the net the increase or decrease of it is the net result of this capital allocation framework that Hims has, that Andrew Dudeman and Yumio Coupe are fielding. If we look at free cash flow per share, it's done nothing but linearly ascend for 8 straight quarters in an impressive way. And I say, and this is where I'll wrap up, free cash flow per share is the basis of all stock value. We talked about it in depth on the live stream. And that doesn't just go for Hims. You can apply that to any stock in the world, any business, the pizza shop down the street. And ultimately, stock prices follow free cash flow per share over time. And that has been very true with Hims, where the stock has fallen for years and years at a time. And meanwhile, free cash flow per share keeps going up. The market says Yumio Coupe, Andrew Dudeman don't know what they're doing. They don't have good capital allocation frameworks. The unit economics are impaired. And what does reality state? Reality states in the form of free cash flow per share that the business is improving, that they are not excessively diluting, that they are competently allocating capital.
I want to close with a non-earnings related topic and a non-financial topic. And I didn't send this along to either of you in advance, so who knows what we'll have to say about it. On Twitter, there's this guy, Akti Diplomaten, if I'm saying that correctly. It translates, I think, in Swedish to the Swedish diplomat. People take note of him because he predicts things and then 2 or 3 weeks later they come true. He seems to have insider access, not exactly clear where that's coming from. Nevertheless, he came out on November 3rd, so Sunday, saying, rumored to come soon at Hims, meal replacements for weight loss, including bars and shakes in a variety of flavors. I see this more as a supplemental addition to their portfolio, similar to what they offer at wholesale, which Andrew views more as a marketing strategy. There are a few other tweets. Meal replacements would be an interesting diversion from what Hims has done in the past. Of course, it's a drugs company. They sell drugs. Meal replacement is a little different. There's a little discussion on the Discord. Most people pretty pessimistic about it. There's a little discussion on Twitter. Most people pretty pessimistic about it. How do you both feel?
I'm actually less pessimistic about this than others. If you look at Hims' portfolio, they have over-the-counter products for skincare. They have creams and things like that. They have non-prescription hair stuff. And compared to some of the other speculative things, predictions that people are putting out for Hims, I think this one is probably more realistic than other things like peptides and other things that have been mentioned on Twitter and Discord and stuff like that. So if this were to happen, I wouldn't be that surprised. I think there's also discussion about how this whole meat replacement market is actually pretty substantial with Huel and some of the other popular ones that are out there. So yeah, I don't think I'd be surprised if they came out with it.
Any idea what the margins are like, Lewis, or like how meals compare to drugs, generic drugs?
I mean, I would guess the margins are pretty rough. To me it is not. To me it's very compelling, but it's not compelling because they're going to be making, they're building the next Google on, high protein, balanced, high nutrient dense meals. I think what's most exciting to me is that this demonstrates that they are an innovative multi-product platform. And we should post my 7 points in multi-product value to Him's house. But it truly cannot be overstated how important it is for Hims to continue to evolve as a loose competitor to the primary care physician market. In the case of a primary care physician, they have an entire arsenal of drugs and protocols and partnerships and treatments that address a wide variety of conditions. And ultimately, at scale, the aggregate of all of these primary care physicians throughout the United States, we have a huge, very lucrative business that has been making general physicians, quite wealthy, relatively speaking, for decades and decades in American history. And so the primary thesis for Hims is that it is a vertically integrated competitor to primary care physicians. This is not perfectly one-to-one. There's a lot of wood to chop, but we're chopping wood by adding more products, more treatments to the platform. And so it's a vertically integrated competitor to the primary care market. And as such, it should continue to capture market share within that market. It's very large. And in order to do so, it needs to continue to add new products. It needs to continue to find unique ways to serve to serve patients throughout the United States. And ultimately, the number one, where rubber meets the road, what is the value of this is expanding the lifetime value of each customer and the cash flows that customer will produce, which ultimately influence the total value of the business. So Hims should continue to bring these unique products to market. I'll say the food isn't so exciting to me, but if they can integrate that into a holistic offering that has big attractive net promoter score, that increases adherence to treatment, that demonstrates, clinical outcomes that are attractive, then that's really compelling. But I mean, frankly, I just want to see, high margin products being layered on. I don't know that selling, HelloFresh, I don't know that becoming a HelloFresh competitor is totally exciting to me.
HelloFresh is different than these meal replacements. Like, I think this is more in line with the pre-made ones like Huel rather than HelloFresh, where they send you like actual recipes and fresh food though, right?
I actually don't know what HelloFresh supplies exactly. My thinking was that it was going to be one of those like pre-made meals with like steak, broccoli, and rice in it. I didn't look at exactly.
Okay. My impression is it's more of the Huel type, where it's like a shake or a bar or something like that, where you would eat this thing that's already made and it replaces a meal that you would normally cook. So HelloFresh is more like they send you a box with fresh lettuce and a piece of steak and all the sauces and stuff like that. So I don't think this is what that Twitter poster was alluding to. I think they're more alluding to the Huel type, where it's like a shake or a like a protein bar type of thing.
Yeah, I'm looking at Google. Huel is not selling food. They're selling that certainly doesn't look like food. It looks like powders and other stuffs that may fill you up just as well.
Yeah, I don't blame Lewis because he lives in the wild and hunts meat with his bare hands and while lifting weights and the other. So I don't think he's aware of this other ecosystem of.
I'm not the Liver King. Is this the Liver King? Are you making a reference with controversial?
No, I'm making reference to the size of your arms.
I did flex on the live stream last night.
Oh, yeah.
Well, I don't know, I'm not, but yeah. So I think it's a funny joke, Dr. Reed. But yeah, I don't, at any rate, whatever it is, it's exciting to me. The more HIMSS can have fun and create unique products that improve people's lives. It's just a matter of chopping wood and developing the arsenal of products that HIMSS can then use to create value for people and to siphon market share away from this giant, highly fragmented, relatively low net promoter score market that is urgent care and primary care physicians. And there's nuance to that. We've talked about it on past podcasts and how they're actually competing.
But even if, I guess to summarize, even if the margins aren't quite as attractive, it's consistent with the company's approach to healthcare, to building a multi-product platform. And for those reasons, there's at least some reason to be excited. 2 quick corrections. Number 1, Akti Diplomat and the guy on Twitter, I think it's not Swedish diplomat, it's stock diplomat. I don't talk Swedish, so I don't fully know, but I do think it is Swedish for stock diplomat. And then number 2, this is just a rumor. HIMSS is not necessarily coming out with meal kits, but something to monitor in the coming weeks. Before we go, any final words on Q3?
Dr. H, if you want to hit us with your final concluding thoughts, and then I'll share some brief stuff.
Yeah, I mean, just as a personal investor in the company, since it's SPAC days and with every earnings, there's no predictableness of what the stock action does in the next few days. So a lot of the Discord discussion was, why is it going down? Why is it red? It was a blowout report. It was a great report. And just as someone who's been here for a few years, I'm like, I didn't even think twice about it. It was just like, this is what the market does. If you have that conviction in the company, you just, ride it out and keep following the reports. So that's my thought on it.
And for me, I'll just approach this through a rigorous quantitative lens, irrespective of everybody's opinions out there in the social media landscape. It's indisputable that sales and marketing as a percentage of revenue came in at its lowest level, effectively its lowest level ever, demonstrating the efficiency that HIMSS is getting on its marketing spend. CAC per net new sub came in at a very healthy range. The number of subscribers buying multiple products grew. That is improving. And so we're getting this perfect storm of exactly what we want to see from the business. And with all of these metrics coalescing, we should expect that free cash flow per share and free cash flow margins continue to expand. And that's exactly what we've seen. So the thesis is stronger than ever. We're right on track. We have our specific quantitative metrics that define that reality. These are metrics that we've been tracking for years now. They continue to be very healthy. Will they be healthy at 10 million subs? Well, HIMSS needs to continue to find ways to serve those afflicted with certain conditions, and needs to continue to grow the number of way it serves while also growing its existing categories. But as of today, everything is right on track. I have no complaints, and qualitatively, the business is doing very well.
Just to close, if you have not liked the video or subscribed to HIMSS House, please do. If you are watching on YouTube, apparently that helps us and helps the algorithm, and we would love if you did that. This has been HIMSS House, episode 12. Thank you so much. We'll see you next time.